We begin with Chapter 8. In this chapter, we will analyze in detail the long put position. The long put position is used when the market outlook is bearish. The strategy consists of buying a put option. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contract, and besides, the values do not include brokerage commissions. The maximum profit on this strategy is limited. The most we can make is equal to the strike price minus the premium paid multiplied by the number of shares. This occurs if the stock price falls to zero. On the other hand, the maximum loss we are exposed to is also limited. The most we can lose is equal to the premium paid multiplied by the number of shares. The break-even point is equal to the strike price of the option minus the premium paid. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a profitable situation. In contrast, for stock prices higher than the break-even point, we are in a losing situation. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the cost of the put. This is the minimum amount of money that must be deposited into our account in order to place the trade. An increase in volatility helps the position. On the other hand, time decay hurts the position. With respect to exit conditions, to close the position, we must sell the put. If the stock price is lower than the break-even point, we are in a profitable position. Otherwise, we are in a losing position. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at the time of put purchase. As we get closer to put expiration, the curve of profits and losses is like the one shown in green. And finally, at put expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the value of the break-even point decreases, notice how it moves to the left, and as the value of the break-even point decreases, the range of prices for which we are in a losing situation increases. Therefore, in this case, time decay hurts the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Amazon company. As we can see, on February 14, 2011, the company gave us a clear bearish signal because the stock touched resistance and was accompanied by a decline in volume and an RSI above 70%. As we said on Monday, February 14, 2011, Amazon gave us a clear bearish signal. In order to take advantage of that, suppose at that time we had decided to buy put options. At the close of that day, Amazon was trading at about $191. So we had bought two put option contracts with a strike price of $190 and expiration in March 2011. That is, we had bought two Amazon March 2011 190 strike puts. The February options expired on Friday of that week, so it did not make sense to buy them. The premium of each contract was $6.5, so a single contract had a cost of $650. Remember that an option contract represents 100 shares. Thus, the two contracts would have cost us $1,300, with the two contracts we would be in control of 200 shares. A few days later, the stock started to fall until it reached the price of $169 on March 1st, touching the 1-month support. It is important to mention that when we choose the contracts to open a long put position, we must consider the following points: strike price, expiration date, and liquidity. With respect to the strike price, in general, the most appropriate choice is to buy the out-of-the-money option nearest the current stock price. The expiration date will depend on the horizon of investment. And regarding liquidity, it is recommended that the option has a spread, that is, a difference between the bid and ask prices of less than 20 cents. In our case, the put options we bought were out of the money because their strike price was lower than the stock price. The strike price was $190 and the stock price was $191. As we had said, we bought the puts on February 14, the day we got the bearish signal, and a few days later, the stock started to fall until it reached the price of $169 on March 1st, touching the 1-month support. At that time, the premium of the contracts was a little more than $21, so the two contracts would be worth approximately $4,200. If we had sold them at that time, we would have made a profit of $14.5 per share, because we had bought at 6.5. Thus, we would have had a total profit of $2,900, making a 223% return on investment in only 15 days. After March 1st, the stock price rose for 2 days, but then fell to a low of $161 on March 15, 3 days before the option's expiration. At that time, the stock established a new 3-month support. That can be seen here. After March 1st, the stock price rose for 2 days, but then fell to a low of $161 on March 15, establishing a new 3-month support. At that time, the premium of the contracts was about $29, so the two contracts would be worth approximately $5,800. If we had sold them at that time, we would have made a profit of $22.5 per share because we had bought at 6.5. Thus, we would have had a total profit of $4,500, making a 346% return on investment in only 29 days. Here we can see the numbers of our example. The strategy consisted of buying 2 Amazon puts with a strike price of $190 and expiration in March 2011 at $6.5. Remember that the premium of an option contract is expressed per share. Therefore, our investment is equal to 6.5 multiplied by 100, which is the price of each contract, multiplied by 2, which is the number of contracts bought. That is a total of $1,300. This money is debited from our account. The initial margin required is equal to the 100% of the cost of the puts. That is $1,300. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is equal to the strike price minus the premium paid multiplied by the number of shares. That is $36,700. This occurs if the stock price falls to 0. If we had sold at 29, we would have made a profit of $4,500. On the other hand, the maximum loss that we are exposed to is equal to $1,300. That is, the entire premium paid for the options. The break-even point is equal to the strike price minus the premium paid. In our case, 190 minus 6.5, which is equal to $183.5. Here we can see the order we must enter to open the position. It consists of buying 2 Amazon puts with a strike price of $190 and expiration in March 2011. In the side column, we select the action Buy to indicate the purchase of options, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $6.5 and the order type is Limit. That is, we want to buy the options at a maximum price of $6.5. Remember that the premium of an option contract is expressed per share. In the Time in Force column, TIF, we select the option Day to indicate that we want the order to remain open only during the trading day. In the Instruction column, we select the specification All or None, AON, to indicate that we want the order to be executed only in its entirety and not partially. And in the Exchange column, we select the option Best to indicate that the routing of the order will be made automatically by the broker. On the other hand, here is an example of the order we must enter to close the position. It consists of selling the 2 Amazon puts that we had bought. In the side column, we select the action Sell to indicate the sale of options, and in the Position Effect column, we select the option To Close to indicate that we want to close an existing position. The entered price is $29 and the order type is Limit. That is, we want to sell the options at a minimum price of $29. In the same way as for the order to open the position, in the Time in Force column, we select the option Day. In the Instruction column, we select the specification All or None. And in the Exchange column, we select the option Best. Here we ended with the chapter Long Put. In the next chapter, number 9, we will analyze in detail the Short Put position.